When the conversation turns to inflation, a common belief takes hold that rising prices and the interest rate hikes meant to combat them are a death knell for technology stocks. But the relationship between tech and inflation is far more complex and revealing than a simple inverse correlation. At its core, a company's value is based on the idea that a dollar today is worth more than a dollar tomorrow. This is the principle of the time value of money, which accounts for inflation eroding purchasing power. Analysts use a tool called the discounted cash flow, or DCF, model to figure out a company's current value by projecting its future earnings and then discounting them back to the present. A crucial part of this equation is the discount rate, which is directly tied to a company's cost of capital and includes a factor for inflation. When interest rates rise, the discount rate goes up, and the present value of all those future earnings goes down. For most companies, this has a negative effect. But for growth-focused tech firms, the impact can be disproportionately severe because their valuations are heavily based on profits many years in the future. We have to distinguish between two very different types of tech companies. On one side, smaller, less profitable startups that rely on a low cost of capital to fuel expansion feel the pain most when borrowing costs climb. On the other side, a handful of mega-cap technology giants like Microsoft, NVIDIA, and Adobe have built immense cash reserves and operate with minimal debt. For them, higher rates can even be beneficial, as they earn significant interest income on their huge cash piles. One study found that companies like Meta, Microsoft, and NVIDIA made nearly $1 billion more in non-operating income than they spent on interest expenses. This resilience helps explain why the Nasdaq 100 has so dramatically outperformed the small-cap Russell 2000 during periods of rising rates. Looking back to history, during the Great Inflation of the 1970s, when inflation soared past 10%, the nascent tech sector was hit hard. The tech stock crash of 1970 saw average computer stocks fall by 80% from their peaks. Some, like Electronic Data Systems, fell by 85%, and even IBM lost 42% of its value. This wasn't just about inflation, but also about unsustainable valuations. In 1968, the average tech stock P/E ratio was 114, compared to the Dow's 16, making the market vulnerable to correction. From the 2010s to 2021, tech stocks thrived on low interest rates and abundant liquidity. But when inflation and rates climbed in 2022, the sector corrected sharply, underperforming the broader market. Then, in 2023 and 2024, despite elevated rates, tech rebounded spectacularly. By 2025, tech sectors were again outperforming the S&P 500, powered by the unrelenting demand for artificial intelligence. Inflation also creates real operational headwinds for tech companies. Rising prices mean rising costs, from labor to cloud infrastructure and hardware. Companies must adapt by conserving capital, trimming unnecessary costs, and boosting productivity through automation and AI. Customers, too, scrutinize spending, which means nice-to-have technologies may slow, while must-have solutions remain in demand. The impact varies across subsectors. Software as a service, SaaS firms, with gross margins around 70–80%, are insulated from rising raw material costs, but face the dilemma of raising prices to offset labor and hosting expenses. Hardware and semiconductor sectors, however, feel inflation more directly. The COVID-19 pandemic exposed supply chain weaknesses, causing chip shortages that contributed to inflationary pressures. Rising manufacturing costs and geopolitical initiatives like the U.S. CHIPS Act have made semiconductor inflation a lasting reality. The most powerful force today is the AI boom, which acts as a counterforce to inflation. Companies are investing in AI to boost productivity and cut costs, making it a top priority in an inflationary environment. Firms involved in chip design, data processing, software, security, and data center electrification are particularly well positioned. Companies like Nvidia and Broadcom have continued their momentum, with stock prices soaring regardless of interest rate movements. Looking ahead, the Federal Reserve is expected to cut short-term rates, but stubborn inflation may keep long-term bond yields high. This suggests that a simple "Fed cuts are good for tech" narrative is too simplistic. Large, profitable tech giants with AI leadership are likely to dominate, while smaller, unprofitable firms may continue to struggle. In a world of persistent inflation, the assumption that higher rates are universally bad for tech is misguided. The key is to examine the fundamentals of each company. In the end, it is a story of resilience, innovation, and a powerful new technology that is rewriting the rules. If you found this video helpful, make sure to like, subscribe, and stay tuned for more tips and strategies to grow your financial knowledge.